Personal finance for entrepreneurs. I want to talk about personal finance for entrepreneurs. It's one of those subjects that most people assume they understand, right up until the moment they realize the advice they've been following was written for someone else entirely. I want to talk about what mainstream personal finance advice gets wrong about managing money as an entrepreneur. And I want to be upfront, this is not financial advice, it's an entrepreneur's perspective, formed from 23 years of running online businesses remotely, managing irregular income, making financial decisions without a salary safety net, which is a longer way of saying I've made enough mistakes in this area to have developed some opinions worth sharing. The first thing worth understanding about personal finance for entrepreneurs is that almost everything you've ever read or watched about managing money assumes you have an employer. It assumes a salary, it assumes an employer pension contribution, it assumes sick pay, paid holiday, and a predictable monthly income. Remove those assumptions and most of the advice stops applying immediately, which is unfortunate, because most entrepreneurs remove all of them simultaneously on day one and then wonder why the budgeting spreadsheet doesn't work. So let's talk about what actually matters. The first area is income and cash flow. Managing money as an entrepreneur starts with accepting that your income is irregular, not slightly irregular, sometimes dramatically irregular. A budgeting system designed around a fixed monthly salary breaks the first month it encounters a slow quarter. The solution is not to pretend the income's regular, it's to build systems that function despite their irregularity. The most important number you need to know as a self-employed person is your baseline, the minimum monthly amount required to cover all personal fixed costs. Rental, mortgage, utilities, food, insurance, any loan payments, this is your floor. Every financial decision you make starts from here. I have known entrepreneurs with significant business revenue who genuinely did not know what their personal monthly floor was. That's like running a business without knowing your break-even point, which some of them were also doing as it happens. The second area is what I call the income buffer. This is the concept that mainstream personal finance advice covers least well, and it's arguably the most important financial tool an entrepreneur has. Most people are familiar with the idea of an emergency fund, a cash reserve for unexpected events. The income buffer is different. It's not for unexpected events. It's for the entirely predictable reality of irregular income. It's a dedicated cash reserve, separate from your emergency fund and separate from your business accounts, that covers your personal baseline cost for a minimum of 3 months. The reason it matters beyond the obvious financial one is this: financial stress affects decision-making quality. An entrepreneur making decisions under financial pressure makes worse decisions. I've experienced this directly. The months when the income buffer was low were the months when I made decisions I would not have made otherwise, accepting work I should have declined, making reactive choices rather than considered ones. The income buffer is as much a cognitive tool as a financial one. It protects the quality of your thinking, not just your bank balance. 3 months is the minimum, 6 months is more comfortable. The right size depends on how volatile your income is. More volatile income requires a larger buffer. Building it takes time and discipline. In good months, directing a percentage of income above your salary into the buffer until it reaches the target, then maintaining it rather than spending it, which sounds obvious. It's less obvious when the buffer is full and there are things you want to buy. The third area is separating business and personal finances. This is the most common and most damaging financial mistake I see entrepreneurs make. Mixing personal and business money creates confusion. It complicates tax, obscures how the business is actually performing, and makes personal financial planning almost impossible. The fix is straightforward. Completely separate bank accounts, separate cards, and a formal documented salary paid from the business to personal every month. One discipline applied consistently makes everything else significantly cleaner. For context, I use Xero for business accounting and Wise for international payments and currency management. Both have been essential for running a location-independent business cleanly across multiple currencies. Links are in the description if you want to explore either. Now, the fourth area is tax, and I'll be brief here because tax rules vary by country and change regularly. This is genuinely an area where professional advice is worth the cost. What I will say is this: unlike employees whose tax is deducted at source, self-employed people receive gross income and pay tax later. The discipline of setting aside an estimated percentage of every payment received into a dedicated tax savings account and never touching it is one of the most important financial habits an entrepreneur can build. The alternative is spending money that was never really yours and then facing a tax bill that feels like a punishment, but it's actually just arithmetic. The fifth area is retirement. For employees, some pension savings happen automatically. Employer contributions, salary sacrifice, automatic enrollment. For entrepreneurs, every aspect of retirement provision is a conscious decision, which means it's easy to deprioritize indefinitely. There's always a more pressing use for the money. The business needs investment, there's a tax bill coming, something else is more urgent. The most expensive retirement planning mistake an entrepreneur can make is starting late. Compounding works both ways. Starting 10 years later does not mean 10 years less growth. It means potentially decades less growth on everything that should have been invested in those 10 years. I treat pension contributions as a non-negotiable business expense rather than something funded from whatever is left at the end of the month. Because if you wait for what's left at the end of the month, there's rarely anything left at the end of the month. The sixth area, and the one I want to spend a moment on, because it's rarely discussed honestly, is the relationship between income and wealth. They're not the same thing. High income does not equal wealth. Many high-earning entrepreneurs have relatively little personal wealth because everything flows back into the business. Revenue, reinvestment, repeat. The discipline of consistently converting income into personal assets, savings, pension, investments, property, is what builds wealth over time. I've been building online businesses for over 23 years. I've run them remotely for 16 of those years from various locations, including New Zealand, where I currently am. One of the clearest financial lessons from that time is the value of diversifying personal wealth beyond the business itself. Your business is already your largest financial concentration. Your time, your energy, your capital, building personal wealth outside the business reduces overall risk significantly. For me personally, purchasing property in New Zealand's been one of the smarter financial decisions of the last several years. Not a guaranteed outcome for anyone. Property markets vary, timing matters, but the principle of building personal assets outside the business is one I would apply regardless of the specific vehicle. The final thing I want to say about personal finance for entrepreneurs is about mindset rather than mechanics. Most personal finance advice focus on wealth accumulation. Build more, save more, invest more. That framing is incomplete for entrepreneurs because it ignores resilience. Resilience is the ability to absorb shocks, survive bad periods, and continue operating through difficulty. It is what the income buffer provides. It's what diversified personal assets provide. It's what not relying solely on the business as a pension provides. Wealth and resilience are related, but they're not the same thing. And in my experience, resilience is the more valuable of the two, particularly in the early and middle stages of building something. I've put together a practical checklist covering all of this: income management, the income buffer, business and personal separation, tax, retirement, protection, and financial mindset as a downloadable guide in the operator's library on my website. Link is in the description. It's not financial advice. It's an operator's perspective documented honestly for people building something on their own terms. If that is the kind of content that is useful to you, subscribe, because there's considerably more of this to come.